Hi, this is Carla Jameson. I'm the Education Director of the Urgent Care Association, and I am happy to announce today's webinar, the COVID-19 resource webinar called Updates on the CARES Act and Paycheck Protection Program. The speaker for today is Rob Kriegler. Rob is a managing director with Mariner Health Wealth Advisors and has over 5 years of experience in accounting and financial services industry. He was previously a partner with Withum Smith & Brown, PC, a public accounting firm, where he developed a specialty focus in healthcare companies, including ambulatory surgery centers, urgent care centers, and physician practices. Rob holds a degree in accounting from Keene University. He's a member of the American Institute for Certified Public Accountants and a member of the New Jersey Society of Certified Public Accountants. Before I turn today's webinar over to Rob, I would just like to make a couple of housekeeping announcements. Please type in your questions into the question box, and then Jennifer, who is one of Rob's partners, will come on at the end of the webinar to help facilitate those questions and to get you guys those answers. There is a PDF of the PowerPoint available in the handout section on your dashboard. So if you'd like to access that, please go ahead and download that during the webinar. We are recording this webinar and it will be available tomorrow. You'll receive an email with that recording. And then also, I'd just like to remind you at the end of the webinar, there is a very short evaluation. If you could take a minute to complete that, we would really appreciate it. So that is all I have, and I am going to go ahead and turn this over to Rob. Thanks, Rob.
Terrific. Thank you, Carla. I appreciate the introduction. So some of the information here that's on this PowerPoint as we go through it has changed in the last few days. The information is coming out on a regular basis. I'm reading new articles and new clarification on these rules on a daily basis. So I'm going to hit some highlights through this, and whatever information is not included in the PowerPoint, if you have follow-up questions, clearly after the presentation here, we'd be happy to answer them, but also we'll give you Jennifer's contact information at the end. If you have follow-up questions afterwards, we'd be happy to help you. To give you some background on what the Paycheck Protection Program is all about, first round of funding came out in April, rushed to the table. They within 2 weeks, had exhausted all of the money, $340 billion. So they came out with a second round of funding. That began on April 27th. There is still, now the statistics you see here on the screen through May 8th, still that's the last information, believe it or not, that we have on the second round. There is, we're told, $124 billion left in this second round of funding. But you must apply by June 30th if you're interested in getting anything. The formula that they're using has changed slightly from the original formula in the first round. And the reason for that is they're looking at a covered period of 24 weeks instead of 8 weeks. And I'll explain what that means. And we'll go through that a little bit later in the presentation. And the reason for that is part of the forgiveness calculation. There were a couple of large entities that took some of the PPP money in the first round that really surprised a lot of people. Companies like Shake Shack, Ruth's Chris, AutoNation. AutoNation is a used car and new car dealer, sales dealer. They took $80 million in funding. All of those companies, even the Los Angeles Lakers, took $4.6 million. All of those companies had to return the money because some of them are not private companies, they're public. They have more than 500 employees. For instance, Shake Shack had 6,100 employees. So we're not even sure how they got through that first round, but all of that money's been returned. And that's probably why there's somewhat of a surplus still there. Carla, the next slide. On June 5th, recently, the Flexibility Act came out to clarify and change some of the rules. The old rules are from the original Paycheck Protection Program, It gave information on what needed to be spent, how the money needed to be spent in order to be forgiven, the term of the loan and the interest rate and everything else. On June 5th, the Flexibility Act changed those rules. So the covered period is the period of time that the calculation must be done to determine whether or not the funding can be forgiven. The old funding rules stated that 75% of pay must be used for payroll costs, and that was wages, health insurance, a portion of the retirement plan, and certain state taxes, and then 25% for other eligible expenses, and that included rent, mortgage, interest only, utilities, and believe it or not, included in that utility calculation was also something called transportation costs. If the company was a transportation company, for instance, a trucking company, they could then expense gas costs under the utility. That was later clarified as well. So the new rules, by extending it to 24 weeks, gives anyone using those funds the ability to make sure to use up the funding truly for payroll costs, but also lowering it to 60% helped significantly. A lot of companies, including urgent cares, found it difficult because business was down to use the funding for 75% for payroll costs. So lowering that percentage to 60 made a big difference. There were very strict rules on employees and full-time equivalents and the numbers that you had to have in place, but they've changed those rules as well, and there are certain safe harbors. I've gotten a lot of questions on that from clients of mine regarding how do I make sure that I fit into that safe harbor. I've had to lay people off. We'll talk a little bit more about that later as well. Some of the old rules are still in place for anyone who received PPP funding prior to June 5th. For instance, if anyone received the money prior to June 5th, you'd have the option to elect 8 weeks as a covered period or 24 weeks. So because the rules changed late in the game, I believe that what they wanted to do was anyone that fell into that covered period of 8 weeks could just go ahead and request the forgiveness. They have the option to use a 2-year repayment period or the 5-year repayment period, again, if the money was received prior to June 5th. Interest is accruing during the period of time when the money is received through final payment of the loan. So even though there is a deferral period, there's an election of 6 months if you receive the money prior to June 5th, or up to 10 months in deferral if you receive the money after June 5th. So the thought behind that is that there is a period of time when you have to make the application for forgiveness. That is a 10-month period. So if your funding was received on, let's say, April 1st, and you elect to use that 8-week period, which would be through May 31st, you'd have 10 months from that date to put in for the application for forgiveness. You do have time to wait to see if there's additional clarification, and I think that's a concern of many, is why request funding now if in fact there's further clarification coming. Just know that if any portion of the loan is not forgiven, it's accruing interest at 1%. Okay, Carla, next slide. Some of the questions that I get is on the payroll costs, and it's very clear what that needs to be, what the SBA intends the 60% of the payroll costs to cover. Salaries, wages, and commissions, obviously, but they're capped at $100,000 per employee. Some of the questions that I get in the urgent care space is that most providers, doctors, don't make $100,000 or less. They typically make more than that. It is capped for that reason, but if you are using a 24-week period, you're going to look at a maximum amount for those employees at $46,154. That's in all over in the literature now. It wasn't very clear before. It appeared that you had to stick to the original $15,385, which would just be that 8-week covered period. So they've clarified that and expanded that. Sole proprietors also, and Schedule C individuals can benefit from that or are capped at that amount as well, but they benefit from that $46,000. One of the questions that I typically get from clients is, what information do I have to save, particularly when it comes to payroll costs? If you have employees, you'll have payroll records. There will be government quarterly reports that go in, 941s, annual reports, 940, payroll records in general. You don't need to supply all of those records to the lender. However, you will need to supply them with the government quarterly payroll reports. You should maintain the other records, which could be time cards, handwritten payroll details, because that information would act as support for the forgivable loan amount. One of the other questions that I've gotten a lot is about audit, or whether or not someone would want to take a look at and dig deeper into the forgiveness application and the records that you maintain. Any PPP funding under $2 million will not be audited. The SBA will take a look at the application for forgiveness and the records that you submit to the lender. However, there won't be any audits on any funding for loans under $2 million. They're suggesting that every loan over $2 million will be audited. So if you've benefited from a PPP loan for over $2 million, be prepared, talk to your accountant, make sure that you've got your records in place. Don't know when that would happen or how quickly, because right now they're understaffed, but they'll probably look to outsource a lot of the audit or follow-up verification on that. Next slide. So the other eligible expenses that you're allowed to use the money for, the 40%, payments of interest on a mortgage. Now it's only the interest and not the principal portion, as long as that was in place and it incurred prior to February 15th. Rent payments, you'll probably want to have a copy of your lease handy in your documents. It's not something that you'll have to supply to the lender. Utility payments, proving that the payments were made. You'll probably want to, we haven't gotten a complete list of documents that the lender is going to ask for or need, but you'll probably want to be ready to supply the invoices that were paid from the PPP funding to your lender. Here's one interesting note that continues to pop up throughout all of this clarification has not changed. If the borrower, if you've received an SBA economic injury disaster loan, not a grant, but a loan, and it was made to you between January 31 and April 3rd, and you use that EIDL loan for payroll, you must use the PPP funding to pay that back. Very easy to go back into your records to show if you've got other sources of funding for the payroll or revenue that was used for payroll during that period and not the EIDL loan. But that's something you need to be very careful of, because they will not forgive the portion of the PPP funding if it wasn't used to repay that EIDL. And that interest rate will then go up to 3.75 because it then becomes part of that EIDL loan. So just be very careful, you know, when you're going through your calculation for forgiveness. Next slide. So there's on June 16th, they came out with two loan forgiveness applications. I want to get into that just a little bit here. That's the number one at the top. Each one of these loan applications, you're going to self-certify, even if your loan is greater than $2 million. But you'll need to self-certify, explaining that all the information you've given them is accurate and true. If you're going through bankruptcy at any point during this process, or if you were in bankruptcy when you applied for the PPP loan, it will not be forgiven. I don't know exactly how the recourse, if there's any recourse to come after you, because it's not personally guaranteed, but it will not be forgiven, and that's a very important question in that loan application. There's 2 loan forgiveness applications, both out June 16th. One is an EZ application. What that means is the initials EZ, just that it's intended to be easier than the longer application. And the only people that can use that are self-employed with no employees, anyone who has employees but did not reduce salaries and hours more than 25%, and if you've experienced business reductions due to the COVID-19 virus and did not reduce salaries more than 25%. Basically, those 2 items are the same. The instructions that go along with that are pretty self-explanatory. There are a couple of safe harbors for the FTE, the full-time equivalent, and I'll go through those a little bit more in detail in a moment. But the instructions, as I said, are pretty easy to follow. Something else that's very interesting is this Section 2302 of the CARES Act. Originally, it didn't allow employers to defer the payment of employer portion of the federal payroll taxes. That means that Social Security portion. And what that means is that the 6.2% of wages up to $137,700 is Social Security tax that the employer pays. Originally, if the loan was forgiven, you could not defer those taxes. You had to pay them if they were incurred between March and December of 2020. Now what they're allowing you to do under this Flexibility Act is to defer those taxes. They still have to be paid, but 50% would be paid by December 31, 2020, and 50% would be paid by December 31, 2022. And yes, those dates are both correct. Believe it or not, you're going to get a year and a half to pay those taxes, 50% of those taxes, for the Social Security portion only of any wages paid. Okay, so there's 2 other sources of funding, and then I want to talk about something that's real exciting, believe it or not, in my world, exciting, for the PPP application. The additional sources of funding, as I said, were the Economic Injury Disaster Loan. As long as that loan wasn't received earlier in the year, then you don't have to pay it back with the PPP. You can continue to use it, and your PPP can be forgiven. But you can still apply for those right now through the end of the year. There's another program out now that is federally backed, Main Street Lending Program. It is brand new. We don't have a lot of details. There are 3 separate platforms. There are minimum and maximum funding amounts. The maximum funding amount is up to $50 million. They have not given us interest rates, but they have, all of the literature tells us that the interest rates are very low. It's through the Federal Treasury in Boston. And we don't yet know which banks are going to be approved to do that lending. They haven't done that yet. So this is so brand new. It's coming out probably in the next week and a half to 2 weeks. But it's been voted on, so it's all approved. As I said, there are 3 platforms. You look at your EBITDA, and then you have a multiplier of 6 or a multiplier of 4. There's some maximum and minimum funding amounts. More on that to come. Let's see. So the real exciting thing that I wanted to talk to you about is this next round of PPP funding. It's called P4, Priority Paycheck Protection Program. P4 is easier. What they're suggesting right now, and it just came out on June 18th last week, it has not been voted on. We expect that vote to occur in the next week and a half, however. And the idea behind it is that anyone who's already received a PPP loan is now eligible to apply for the PPP-4 loan, and that too can be forgiven. The caveat is, though, that businesses with fewer than 100 employees are able to apply for this loan. They'd have to show that they're almost exhausted. They've almost exhausted the PPP loan, and that revenue is still affected, is still down as a result of the COVID-19 pandemic. So more on that to come, but right now it looks as if there's another round of PPP funding that can also be forgiven, even if you've already received funding before. Let's see. I'll make sure I have everything covered here for you. Okay, so I believe that that's all that I have right now. What I'd like to do is open it up to questions. Jennifer, if you'd help me out.
Absolutely. Thank you, Rob. So we do have a number of questions that have come in during your presentation, but we also had some questions that were provided to us in advance of the webinar. So I'd like to start with those. Okay. So this individual, they're asking if they went with the eight-week program for forgiveness purposes, do they have to apply immediately after the 8 weeks, or can they wait until later in the 24-week stretch, just in case there are new changes that they can benefit from?
So the answer is two-part. One is, as long as the funding was received prior to June 5th, they can elect either the 8-week period, 8-week covered period, or the 24-week covered period. However, they have 10 months from the date of the end of whichever covered period they've chosen to apply for forgiveness. The last day of any covered period is December 31st, 2020. So an applicant must apply 10 months following December 2020, and that would give us an October deadline in 2021, and then they'd have 10 months from that date to defer the payments if they wanted to, if they elected that as well.
Okay, thank you. So if they choose the 24-week option, do they include the payroll for the entire 24 weeks, or do they select an 8-week stretch within the 24 weeks?
I would suggest you take the 24 weeks. As long as it covers 60% of the funding, it almost doesn't matter which period of time you take, but to be conservative, I'd use the 20, if they elect 24 weeks, use 24 weeks of funding, 24 weeks of payroll.
Okay. And for calculation of any reduction in FTEs, there's a choice among 3 periods. I'm not going to list the entire periods out, but they were starting February 15th, January 1st, and then 12 weeks from May 1st. The period lengths are different. Do you know if there's a reason why?
I believe that they were trying to clarify it for seasonal employees. It was difficult to determine which period of time would cover different seasonal employees. So they gave out different periods for that reason. I don't know that there's any rhyme or reason behind it. I do believe, though, that it was tied back to the seasonal employee.
Understood. Okay. So I'm going to move on to the questions that have come in during the presentation portion. And I will start with the first question said that if they choose an 8-week period, can they use the 60-40 ratio, or instead of the 75-25, are they locked into one or the other?
It's now 60-40. 75-25 is no longer on the table. And I reviewed the applications, and it's very clear in there with the instructions as well that it is truly 60-40.
Thank you. Okay, so a payroll expense question. This individual's loan was funded on 4/16 of this year and would then end on 6/10. May they pay through 6/15?
When you say may they pay through, is it a payroll period they're looking for the covered period. Is that maybe I'm missing something? So the covered.
It
Go ahead.
does say it's a payroll expense question.
Got it. So the covered period is defined in two ways. One, let's assume you're using the 8-week period for this example. So you would determine what was paid during that 8-week period. So in the first week of that 8-week period, you didn't have payroll, but you did in the second week, you'd use that, and then you wouldn't use anything outside of that 8-week period. They've clarified it to further to allow an individual to determine what the payroll amount is if a payroll started after the 8-week period on the 9th week. You could include that payroll as well. So it really basically covers 9 weeks for the 8-week period. The 24-week period has the same caveat. There's an extra week in there because they're thinking that the incurred payroll, whatever was earned but not paid yet, would still be included in the 24-week calculation. So it's truly incurred expenses.
Okay, thank you. Another question from the same individual. For reduction in salaries, does that exclude salaries over 100,000?
Well, it's again a self-certified answer. So if you happen to have reduced anyone's pay by 25% or more, you'd answer the question that yes, that you've done that, even if it's in excess of the 100,000. Don't assume that by capping it at 100,000, that's a reduction in salary, because that isn't what's happening. You're still paying that individual what you'd paid them before. If you've reduced someone's salary by more than 25%, you'll have to answer that question that you've done that.
Okay. So would a lease payment for equipment be considered acceptable as part of the?
That's a very good question. I'm sorry I didn't cover that. I've had that question before, actually. Yes, it's clear that as long as the lease agreement was in place before February 15th, 2020, you can use leased expenses for equipment.
Okay, great. Okay, moving on. Okay, here's another question on FTE. So is it true that with the 24-week period, we have to maintain the FTE through 12/31/20 and not just through 6/30?
No, that's not true. So they've changed that, and there's actually some safe harbors in there. So it's going to be an attempt at a lot of good faith here. So if you have FTEs of 10 through June 30th, and then post June 30th, you lower those below 75%, let's say. So you're now down to 7 or 6 employees. As long as you make a good faith effort to hire them back by December 30th of 2020, the loan can be forgiven. So if you put your application in for forgiveness prior to December 30th and you haven't yet rehired those, but you intend to, you would certify that you are intending to hire them back. So the intent here, and it's very clear in the instructions, is that you've made a good faith effort or you intend to make a good faith effort before the end of the year.
Okay, great. And is it possible for an owner to draw salaries from 2 different companies?
It would be still capped at $100,000. The answer would be yes. It's usually unlikely you're getting PPP funding in both of those unless there's a number of partners that don't create common ownership. Typically, the application for funding should have restricted anyone who has common ownership or significant common ownership in more than one company from getting it in both.
Okay. And then, thank you for that. So this was a follow-up to the same individual who had asked about the payroll expense question over the the period from 4/16 to 6/15.
Okay.
So they said that their payroll started on the 16th of April and paid on the 10th of May.
Okay.
Does that change? I just want to make sure we fully answered that question.
I think I understand what they're getting at. So the period of time following that May 10th payment, you would then use, you would determine what was incurred. So whatever payroll was incurred from when you got the funding on April 16th, obviously May 10th is going to be included in your calculation. Then you've got incurred payroll from May 11th through the next pay date. You would include that also. You'd have to show support for that to show that your pay periods are that infrequent and the period of time you're covering for the forgiveness application is incurred payroll. It will be reviewed by the lender as long as that's a normal pattern of payroll for you. Any of that incurred payroll can be included.
Okay. Because she just wants to make sure that she can pay through the 15th of June.
Yes. Yep.
Okay. Great. And, you know, I'm going to continue on with the questions, but I do just want to take a moment to stop and let you know if you have more detailed questions. We've posted my contact information on the presentation page. Feel free to reach out to myself and I will partner with Rob and we will most certainly get an answer back to you. We understand that, you know, every question in regards to the PPP program is very specific and, you know, we're happy to act as a resource. So I just wanted to say that. So moving on. So is the reduction of hours for someone earning greater than 100,000 covered under any type of safe harbor?
Yes, again, it goes to the good faith that the reduction is due to the COVID pandemic. So for instance, if someone is working to fill hours based on patient volume, that reduction in patient volume is in effect due to the COVID-19 pandemic. So I would assume. So the understanding is the hours would not have been reduced. It's a good faith effort that they would have continued had this not occurred. So that is under the safe harbor rules within the instructions. Yes.
Great. Thank you.
So Jen, I have one point if I can digress just for a moment. Something I didn't mention, but it appears to be you know, positive in the horizon. Currently, the IRS is telling us that we are not allowed to deduct the expenses that the PPP funding covered. And there's some code section 265 that says any non-taxable income cannot have an offsetting expense, deductible expense for federal tax purposes. However, there is current suggestions and legislation out there, it's not voted on yet, but it's out there that will allow deductions for any of the expenses that the PPP funding covered. So if you think about that, you're getting free money basically. The loan does not need to be paid back. However, you're going to get the deduction for it as well. So that's an additional advantage to actually getting this funding. If you know of anyone who hasn't gotten it yet, there's still time, there's still money, but it's something they should do right away.
That's a really good point. Thank you, Rob. And I, you know, certainly I also just want to add that we understand that this has been a moving piece, right, with all kinds of moving parts to it. And we are certainly, you know, happy to serve as a resource again as things change. Don't hesitate to reach out as Rob is keeping up on it. I would say from a day-to-day aspect, but sometimes hour by hour.
That's right.
Happy to act as a resource.
And if this presentation is helpful to everyone on it, then you know, we'll suggest to Carla and her team that we're available to do this again. I assume that in a few weeks we'll have additional clarification and guidance on how this is working, and also more information on that P4.
Great. I haven't seen any new questions come through at this point, so I will turn it back over to Carla.
Great, thank you guys very much. Jennifer and Rob, you did a great job explaining everything. I would like to, thank you everybody who attended. We do have 2 additional UCA webinars coming up this week. Tomorrow we have one on revenue cycle, a disciplined approach to oversight with Jay Tolia, which is tomorrow at 1 p.m. Then we also have one on Wednesday, which is called Survive or Thrive, How E&M 2021 Will Impact Your Bottom Line, and that's with Sharon Nicka. Both of these webinars are part of UCA 2020 On Demand. We took our May convention and created a hybrid event of on-demand and live education. So if you haven't checked it out yet, go to ucaoa.org/convention. We've got 40 hours of CME. Member rate is $4.95, plus there's group rates available. Just email convention@ucaoa.org. So I would like to thank everybody for participating today. Rob and Jen, again, thank you. And this will end today's webinar.
Thank you.